Eugene Fama, University of Chicago economist and father of the efficient market hypothesis, has long been a thorn in the side of active stock managers. His Nobel Prize-winning research dating back to 1970 argues that stock prices reflect all available information and are therefore fairly priced. In other words, trying to beat the market is futile over the long term. However, even Fama has trouble explaining one disturbing pattern. In a 1998 paper in the Journal of Financial Economics, he addressed the phenomenon that stock prices continue to move up or down in the direction of an earnings surprise for as much as a year, describing it as the granddaddy of underreaction events. Fama dismissed this challenge to his efficient market hypothesis, attributing it to pure chance, but a quarter-century later, the effect known as post-earnings announcement drift, PEAD, stubbornly persists. Nowhere is the proof greater than right in Fama's backyard, 25 miles west of Chicago in Lisle, Illinois, at a firm specializing in small and micro-cap stocks called Oberweis Asset Management. Check out these returns. For the decade ending September 2023, Oberweis' $400 million micro-cap growth fund has had an average annual return of 14% versus 3% for its Russell Micro-Cap Growth Index. Its Small Cap Opportunities Fund, also around $400 million in assets, has returned 12% annually versus 6.7% for the Russell 2000 Growth Index. All at a time when small caps funds have been largely left for dead by investors. The recent results are even better. Over the last 3 years, its micro-cap and small-cap funds have generated 27% and 21% returns, respectively. Oberweis' secret? Ferreting out tiny companies with positive earnings or revenue surprises. Investors tend to cling to preconceived beliefs and notions and disregard new information that shows up in an earnings surprise, says Ken Farsalas, 52, lead portfolio manager and director of U.S. equities at Oberweis. Investors are guilty of anchoring bias, confirmation bias, commitment bias, herding bias, groupthink. All of these different biases come into play. They mess with investors' ability to make effective decisions. Ironically, Farsalas and Oberweis president, James W. Oberweis, and his father, firm founder James D. Oberweis, all received their MBAs from the University of Chicago's Booth School of Business. We kind of got brainwashed into the market efficiency stuff there, says the younger Oberweis, 49. It's mostly efficient, but there are these pockets of inefficiencies in small asset classes where our stock selection process has been able to add value. Oberweis Asset Management was founded in 1989 by Oberweis Sr., a former teacher and stockbroker who began publishing a stock newsletter, the Oberweis Report, in 1976. In 2001, Oberweis Sr. went into Illinois politics and son Jim W. took over.